Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso, and today we're going to be talking to you guys about what you should be doing in the face of rising inflation as well as rising interest rates. Anthony, we just interviewed Aaron Chapman for the 14th time, I think, but always good content, right?
It's always good, and I will tell you, to be honest, with inflation and rising interest rates, it made me kind of, man, should I wait to buy a house, or or what should I do? But you know what? I think every time after talking with Aaron, I want to go buy more real estate.
Yeah.
He always, not only does he kind of soothe kind of some of the fear, but he supports it with some facts.
Yeah.
Which is what he did today, and he shared his screen multiple times. And I know most people are listening to this on the podcast, but he does a good job of walking it through. But if you want to see those charts, this will be posted on our YouTube channel. Mm-hmm. Now, Cam, what was some of your takeaways from today?
Yeah, we reached out to Aaron because of everything that's happening and how crazy it is, right? Inflation's going nuts, interest rates are rising, everybody's, what should I do, what should I do? My takeaway was just be patient, right? You talk to Aaron, and what he talks about is there is a gap between where inflation was in the 80s and where we are now, and that there is room for these things to rise, interest rates to continue to rise if it's going to pace inflation. But really what my takeaway was don't be worried, right? If your focus is long-term wealth, a 30-year fixed mortgage has got to be one of the tools of the foundation that you're building. And man, he gives, not only does he give the advice, but like you said, he gives the receipts as well. He's got calculators to support that. And so my takeaway was just be patient, stay the course. And if you look at rates historically, we're still very relatively low. So Anthony, what about you?
Yeah, again, a lot of times we focus a lot on interest rates, but just like you said, he painted a really good picture of interest rates. He went back, I think, to 1971. Yeah. Interest rates were pretty darn high, right? And one thing I think we need to keep in mind with inflation, it does bring rising interest rates. Mm-hmm. But what it also brings is everything costs a little more, aka your rent. You should be able to increase your rent. Also, the value of the home should be going up with inflation, or probably even more. So what he painted that picture is, maybe right now it's going to affect the cash flow if you were to buy a house right now compared to a year ago. But eventually with this inflation, you're going to be able to raise your rents. The house is going to increase, and you're locked on that 30-year fixed. Like that, when we do this investing, we can't do by fear. We have to look at logic. Let's look at numbers, not just focus on that monthly cash flow today, but let's see what it will be like in the future. Aaron always has some great value, and I would encourage you, particularly if you're a real estate investor, to get on his email list and or subscribe to his YouTube channel, because I think once a week he posts something. It's short, maybe 5 to 10 minutes, but he's really keeping you up to speed on what's going on with real estate, and particularly with the interest rates.
Yep. And for those of you that aren't familiar, we interviewed Aaron Chapman. He's the gentleman we're referring to today, but he's with Security National Mortgage, and he is, he's a nationally recognized mortgage broker. Most brokers will do maybe 1 or 2 a month. He's doing $1,600 a year because he's got a niche. He understands the way that investors are approaching real estate, and he's very, very good at communicating that. And so that's our interview today, Aaron National, Security National Mortgage.
Enjoy the episode.
Take care.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Aaron, welcome back, man. We are happy to have you.
Yeah, 4th round, right?
Yeah, 4th or 17th. I don't even know what it is now, but
do you guys have a limit where you let people on, or is it something where you're just trying to find that time where you're just tired of somebody after so many?
If somebody has good content, we're going to put them on. Or if they have a longer beard than yours, they get cut to the front of the next episode.
They got a better shot at it now than since I lobbed that 8 inches off last week. Is the last week or the week before? I guess it's the week before.
Yeah. Aaron, anyway, man, we'll keep inviting you back because right now we invite you back to kind of help us get kind of a handle on what's happening here. And so I'm going to throw it to you, and I'm just going to ask you, what are some of the conversations that you're having with real estate investors as of lately? I know things are moving. Interest rates are going crazy. Inflation's crazy. But what's some of the big topics you're touching on?
Multiple different topics. Of course, inflation's a big topic. Interest rates are a massive topic. There's so many people backing off of what they would be doing had the rate still been at 3% or 4% or even 5%, right? But we've seen that climb so fast. We blew right through the 5s, right into the 6s, within a week for real estate investors. And the thing that I have to go into is to, help them understand what's driving the interest rates. And so I'll ask you guys, do you know where we are right now with inflation?
What's reported or actual?
What's reported at the moment?
I think we're at 9.1.
9.1. So if we go back to where we've been, the target, right? Their target inflation with the CPI was been in the 2s. And then we've slowly been creeping up. You get the new regime in place, if you want to call it that, and then it just skyrockets, right? Well, I'm going to go ahead and you guys are familiar with shadow stats. I think we talked about it before on the show.
Yep.
We're going to do it again here. And I'm going to show shadow stats, at least their what do you want to call it? Alternative data chart. So what it does is it takes the history of CPI and it will take that history and it will show you what the CPI says and then what the real rate of inflation is once they start adding back in the food costs, energy costs, segments of housing, those kind of things that show the full cost of living. So back in the 80s is when they started doctoring the CPI because you understand what commitment they made, for Social Security and other retirement benefits. They would have to increase the income based upon whatever inflation was. Well, what do you do to avoid that, or at least limit that? Change how you calculate inflation. So now we have the red line represents the consumer price index, which is by far the most lied bullcrap freaking name you possibly think of when you think about that. Consumer price index, the price of things you consume. The only things they put into it is that which they can regulate or manipulate with monetary policy. So you can see we've maintained this so-called lower in the below 5% for quite a bit since the 90s. But you and I all know, that what we could spend $100 in the 90s is definitely different than what we can spend $100 on today. That is an easy way to see how this is manipulated. You see the blue line represents the actual cost of living continue to increase. What is key in this is looking at these last couple years. We've seen it jump from somewhere in the 2s, according to the CPI, up to 9.1%. Now you see also the corresponding one, adding all the things back in, we're about probably 17, 18%, the real rate of inflation. Why is this important? Well, they say, and it's evident here, that the inflation is the highest it's been in 40 years, right? Mm-hmm. We go back 40 years ago, the highest inflation was back in the early 1980s. Well, what I tell everybody is, what was the interest rate in the 1980s? If we are mirroring and actually higher in inflation now, wouldn't we likely be what the interest rate was back then? Well, we're going to go ahead and take a look. I'm going to show you exactly what that was. This is a chart that shows you where the interest rates were in the 1980s from peak inflation.
Look at
for
that.
30 years. So for people who are listening to this, the 30-year fixed was at in 1980.
Yep, 1982 is what's referenced here at its peak, and that was about 18 to 19%.
So a 30-year fixed mortgage not only was double digits, but almost 20%.
Almost 20%, and that's the average that was for people buying houses to live in. It's not even for real estate investors. So that's the other thing that you really got to take a look at. Real estate investors typically are 1 to 1.5% higher. So when you put it in perspective, we're 13% off of where we should be? That to me is a really big damn deal. So when people start freaking out, it's like, oh, these interest rates are so high. Like, relative to what? So that is a really, really big thing that people need to understand. The other thing is, what is the federal fund rate? Because the federal fund rate is what they use to try and quell inflation, correct? So what was the federal fund rate today? Do you guys know?
I don't know.
We should know. Aaron always put us on the spot. I remember last time he had us do math.
We're not done. Math is coming. Believe me, math is coming. So right now, currently, it's 1.75%. We're anticipating another raise of the federal fund rate of 0.75 to 1%. So let's say they raise it 1%. It'll go to
Aaron, could you explain to Cameron what the Fed funds rate is?
So that's basically the bank, the overnight rate that people can borrow from the Fed or borrow from other banks overnight. Really, it's just an overnight thing. It's not, people freak out when the Fed raises the rates. It does not directly impact mortgages. It's the rate between banks, more or less.
Okay.
So the federal fund rate right now is at 1.75. If we do a 1% increase next time, we'll be 2.75. Now, here's where it's very, very interesting. We look back in 1980s when Paul Volcker was the chairman of the Fed and see what he did when inflation was at this exact same point. Here's the 1980s. Look at that. Federal fund rate was about 18 to 19%. Very, very interesting. So why is that a necessary thing to quell inflation? Well, that rate, all these rates will affect our credit card rates, our car rates, all the short-term stuff, right? Well, if the cost to use your credit card or to buy cars or consume is much higher, then people won't consume as much. One of the reasons we have such crazy inflation is because the enormous amount of capital that was injected into the market by the U.S. Treasury printing so much money, right? And some of it now it might even actually be printed. It might just be digital dollars shoved out into the market. Then you've got the Federal Reserve taking that money, injecting into mortgage-backed securities and into treasuries to bring the rates down significantly. So buying power increased. People had the ability to purchase more. We have more money going off after fewer goods, right? So think of it this way. If you've got let's say going to a grocery store to buy milk and you see 4 tractor trailers wrapped around the store full of milk, how cheap is milk going to be that day?
Basement. Super cheap.
Very, very cheap, right? Because they got to get rid of it. It's a perishable item. But what if there's only a Toyota pickup out there and it's got 1 case of milk? I guarantee everybody in the store is going to be standing around the customer service counter bidding on those gallons of milk, correct?
Yeah.
And how expensive is milk going to get at that point?
It's going to go through the roof.
So, Aaron, that was one of the questions I was going to ask you is what you believe is causing inflation. And you mentioned the increased money supply. I didn't hear anything about
Don't say it.
anything else. Right.
Hear anything about anything else? Yes. No, you didn't hear anything about anything else. Because we all know that's complete bullshit. I mean, it's just talking points, all the other stuff. The bottom line here is when you have, I think they said it's like, I don't remember the exact statement, but over 40% of the U.S. currency has been put in place just in the last couple of years.
Yeah.
That's madness. Absolute madness, right? So, of course, when you have that much money floating around going after goods, also, what's happening as far as our goods are concerned? What's available, right? We had the pandemic, right? So then it started shutting down people's ability to produce goods, right? They started killing the mom and pops off, leaving the big shops open, directing capital more towards certain groups. So then you have the production of things that are now being affected. We can't get items, right? You got supply chain issues. Now we have the cost of fuel going through the roof because we're shutting down pipelines. We're limiting on the ability to drill. We're limiting on the ability to produce. And all those things are creating now this shortage of an increasing shortage of oil and fuel. Therefore, trucking's having an issue. You're not going to be able to get the things. So the limiting the amount of materials that are out there, plus with what's going on with rates, I mean, it's a big formula for massive inflation. I don't think that we're done with the inflation at this point. But what inflation is doing, that's benefiting us, right? There's a benefit to it.
Let's hear it.
But the benefit is only to the few. And that's the few that park their money into a long-term instrument with a set payback. Now, let's get into the 30-year fixed loan real quick. Because a lot of people right now are going to tell you, you're going to hear a lot of investors right now, you're going to hear lenders tell you, maybe you should look at the ARM or the interest only. So you can get that, and you get better cash flow until the rates go down.
Yeah.
Well, number one, let me ask this one question. Who the hell says rates are going to go down? what is going to drive rates down? It makes sense that you guys are kind of stumped on that, because the only thing that's brought rates down has to do with them producing money and throwing it into the market, right? What I'm showing you here is 2,677 months. I'm only showing you a tail end of it. I'm not going to drag it all through from 1971 till today. I'm giving you the last little bit of that spreadsheet. But if you look on it, the average interest rate from 1971 to 2009 is 9.11%. Meaning from 1971 to 2009, you've seen interest rates as high as 18% we're talking about here. We've seen them during my time. They're the lowest that I had seen before the crash was in the sixes for owner occupied. Actually, they were in the fives for owner occupied, high sixes for actually, they never got into the sixes for investors till after 2009. So high fives for owner occupied was about the lowest rate that I ever seen, 5.75, something like that. And that was a big deal. We broke into the fives. That was huge. So, but then you get into the quantitative easing of 2009. So the average since January 2009, because in January 2009, after the crash, till I think it was it was March. When was that? January till March. I think it was March of that year. I'm trying to remember. No, it's March of the following year. So January 2009 to March of 2010. So it was 1 year and 3 months. They had injected over 1.25 trillion into the market. So the average interest rate from that time till now is 4.02%. Then if you go just back to the pandemic from now, when they dumped in when the pandemic hit, we saw a big, massive move in the market. Then on March 20th of 2020, March 20th, 2020, till March 30th of 2020, that's 10 days, they injected $1 trillion into the mortgage-backed securities market. And they continue to do billions of dollars a day. You've looked at the average interest rate just since March 20th of 2020, the average interest rate is 3.33%. So you take all of that, since 1971 till now, it's 7.769% is the average interest rate, almost 8%. So 7.75% basically. So if all of that's happened, the only time that we've been really lower than an average of about 9% was during the pandemic and during the quantitative easing. It means the only way rates are going to go down is if trillions of dollars got dumped back into the market from the Fed. What is the chances of that happening?
Well, based upon their most recent actions, I'd say pretty good.
I think they're pretty slim, actually, because the recent actions, they're trying to get out of it. So let me show you something else here. In fact, I'm going to have to stop the share just so I can go back. I'm not going to make people look at all these screens. But we're going to look back here so you can see what the Fed has been doing here just based upon the mortgage-backed securities charts. All right, so here we go. So this is you've heard people talk about the U.S. Treasuries as being like their the place where they look for the interest rates. That's a treasury, right? That's just lending money to the government for them to use. That's the T-bills. It's a long-term bond. It's a 10-year bond is what everybody's looking at. This is a 30-year bond, the universal mortgage-backed security. And this particular bond, money goes in there and people expect to have their money stuck in there for 30 years if it's being used. Well, what we see here, this is 2009 and 10, way back up in here, right? So then you can see all that injected capital going in from the Fed, keeping it as high as it's been. And then they started to taper out of it in 2018. They're trying to get out of it. And you see how by them selling off positions and they weren't even really selling off positions. They just weren't reinvesting. Yeah. Right? So it's when loans turn over, more money, they get their loans paid back and they just reinvest it back into the pools. Well, they stopped reinvesting back in here. You can see where that dropped off and they stopped reinvesting. Well, they started putting their reinvestments back in, and then you get the pandemic right here. This is where it dropped hard and they dumped those trillions of dollars in and they kept at it to keep it at this point. This is about right in here is when they decided that this particular line is when they decided to stop, not just in reinvesting, but to start selling off in general. Look what's happened. Look at this drop off. And it's just continued to drop. This is the Fed divesting of their particular position, going back to where it was prior to them getting involved whatsoever, because they didn't start getting involved until 2009. So all of this is is manipulated by U.S. dollars being printed by the U.S. Treasury.
So would you anticipate them just stepping back at this point?
That's the intent. Their intent is to stop getting involved in the mortgage-backed securities and the U.S. Treasuries and have the market kind of take care of itself. Now, whether that's going to shake out, it's not hard to say.
Anthony intends to go to the gym every day too, but that doesn't happen.
It's true. There could be some things that change that. There's no two ways about it. We could get a new Fed chairman. All those things could change. A lot of it can have influence.
Yeah, Aaron, I'm with you in regards to inflation. That it's because of the increased money supply, and that they're pointing fingers at these other issues, whether it's the war, the pandemic, or supply chain issues. But if it's because they injected all this money in, I would expect prices to be similar to where they are now. Like, I don't see them, and I just mean on all assets that got inflated with inflation, because that money supply is still in there. I wouldn't see those assets going down, or am I wrong?
Well, so the thing of it is they're selling those positions, right? When you buy into something, right, you have an asset that you can sell.
Mm-hmm.
Now they're going to sell those positions, but then what are they going to do with the capital? It's not going back in there. I have no idea what they're doing with the capital. I think they maybe they're getting, I don't know, maybe shortening the monetary supply. Who knows what the intent is? But they're not looking to put that back in. The Federal Reserve is not looking to reinvest it. So once they sell those positions off, it's up to the open market, the standard market, to maintain, sell, and trade those. Now, when they try and sell them, somebody has to buy them. You start seeing those negative days on a mortgage-backed securities chart, and you start seeing these down days because nobody's bidding. Finally, somebody bids, well, it's worth a lot less, right? And because of that, a lot of it's another value issue, right? So they're looking for a higher yield before they're going to invest into it. Well, that higher yield means that they want more of a return on investment. They want higher interest rate if you're going to use their money. It's a lot more complicated than just dumping capital in and putting it to work.
Aaron, kind of what I heard, I think that what you're going for was you're showing us where we were in the 80s and where inflation was, and then where interest rates were rising to kind of maybe quell inflation.
Mm-hmm.
Is that what you're kind of showing us, is that, hey, inflation is here for us to get back to maybe slowing this thing down? Interest rates are going to have to rise? They're
going to have to, but they are literally not rising as fast as they should be. So there's something out there called the Taylor rule. You guys ever heard of that?
No.
Okay, so what the Taylor rule is a way of dealing with inflation. What you do is you take your target rate of inflation, and then you subtract your current rate of inflation. You subtract that from your current rate of inflation to get the difference, right? So if the target rate of inflation is 2%, right? We're currently sitting at 9.1, correct?
Mm-hmm.
So what's the difference between 9.1 and 2%?
7.1. That one I got.
Correct. That was sharp. So 7.1. What's half of 7.1?
3.67.
3.55.
Yeah, that's what I said.
That's exactly what you said. So 3.55. So the rule says is you take the target rate of inflation plus the current rate of inflation plus half of the gap. So I'm going to add that up real quick here. That is 14.65. They say that should be the federal fund rate to slow down inflation. We're right now at 1.7.
Yeah, sorry, I cut you off there. What are we at right now?
1.75.
Okay.
And they're talking about raising it 0.75% to maybe 1%. We're still far off of where it should be to slow this train down.
So that's kind of where I was going with that. Is the takeaway from the information that you've given us so far is that to slow this thing down, interest rates need to rise dramatically, and we're not there yet. And so, kind of the common knowledge or the conventional wisdom out there right now is to slow down. What I'm hearing is a takeaway hey, continue to buy, get that 30-year fix, lock in an interest rate, because we are still at historical lows compared to what we were from 71 to 2000 and whatever.
And 100%. Keep doing it, because we're not gonna see I don't know that we're gonna see these rates again. And secondly, we're not seeing where we should be in the rates. Now, I don't know if that's really the play that it's going to slow things down, because they're not really not shocking the system like that, because we have something else that's shocking the system. We have the supply chain issues. That's slowing things down in itself, right? Because it's driving the prices so freaking high that people are slowing it down anyway. So what they were using before was raising the rates to slow things down, because the cost of money was so expensive. To use it to go buy things was too expensive. Now, just the cost of goods themselves are going up so much that it's making it increasingly difficult to acquire them. Therefore, it's going to slow down the buying in itself. So I can't say if rates are going to spike up the way that you would think that they would, because of that fact alone. There's enough slowing things down all on its own without them having to spike it, and maybe they're tiptoeing into it. But also, Jerome Powell in previous weeks admittedly said, what we're finding out is we know very little about inflation.
Yeah.
So that I found very interesting in itself. So let's get to the benefits for the real estate investor when it comes to inflation. So I'm going to share something with you. I probably shared on the previous opportunity, or one of the other 3 times I was on here on you guys' show. But this shows a person buying a house closing at the end of last month, right? And let's say they bought a price of $147,300 was their purchase price, with a loan amount of $117,840. That was their 20% down to 80% loan amount, at a 7% interest rate. I mean, if they financed that, if rates went up and we got 7%, which is not what people want to hear, but it's possible. Okay. That $117,000 would cost them $783.99 a month. Well, that is equivalent over 30 years to $282,237.29, which is paying off the $117,840 loan amount plus interest of $164,379 to be exact.
Okay.
So that's how you get $282,237. But when you recalculate the dollar every time it leaves your hands to pace because of inflation, the dollar's losing. In this chart, I'm using 8%. It's losing 8% of its value every single month, right? And so because of that, every time you're making the payment, not 8% of that, 0.666% of its value every single month, 8% every year. That means you borrowed the money at today's dollar value, put it to work in the market, and bought an asset at today's dollar value. You're paying it back at tomorrow's dollar value. The collective value of all those dollars over 30 years, you pay back $282,237, but you actually paid value-wise $106,845. What's really interesting about that, if you started off with $1,185 a month rent, which is under the 1% rule, right? A lot of people are like, man, $1,185, I paid $147,000 for this house.
Yeah.
$1,185 is what you paid. You rented it for $1,185 a month, but you only raised the rents 3% per year for the next 30 years. You're going to collect $665,000 in rent, but you're only paying back $106,845 in value. Here's an interesting thing here. Get your calculators out.
Okay, go for it, Cameron.
So we're going to take $1,185, multiply that times 3%, so 0.03.
35.55.
Okay, 35.55. That's your
increase in rent.
Increase in rent, right? So let's say in this example, right, that $783 a month payment, you're getting $1,185 in rent. Let's say you're making, by the time this is all said and done, $150 a month in cash flow. Nothing sexy. Nobody gets excited about $150 on a $147,000 house, right?
Mm-hmm.
So take how much was your rent cash? How much did your cash flow go up by?
35.5.
Take 35.55, divide that into 150. So hit your divide button, then type in 150. Tell me what you get.
0.237.
That means your $150 in cash flow increased by 23.7% the next year. Every time you raise your base rents by 3%, you're getting an increase of over 20% in your cash flow every year. Now, I do know you're going to have taxes, you're going to have insurance that are going to adjust, but you have room for that adjustment when you're talking about a cash flow growing by over 20% per year. But the lender's cash flow does not grow, it declines. Do you see where that divergence starts to happen and it gets really, really sexy for the real estate investor?
Yeah, absolutely.
That's a big damn deal, right? And so what I'm showing you here is a tool that I use to calculate this out. This came from the professor of accounting at Kennesaw State University. And I know that people would like to have this particular tool, right? But before you get into this, let me talk real quickly about the ARM thing. I want to make sure people are aware of what they're going to be. Some people say, well, if you get the ARMs, right, you can get lower cash flow for right now. Let's go back to the rate thing. Are rates really going to get better? We don't know that, right? If you get an ARM, you are being forced at that point to have to ensure that the rates get better, because you're going to come to a point 3 years, 5 years, 7 years down the road, you have to refi. And when you have to do something, it better be better. Otherwise, you're screwing yourself, correct?
Mm-hmm.
So you're definitely going on hope. And hope is not a business strategy. In my opinion, you want to go with this because we can map it out. We know what the future is going to be. We know where you're going to end up. Don't let somebody put you in a position where you're going to be forced to have to hope that the market does what it does. And here's another thing that people don't hear. It goes on in the background in my industry. People are talking about using the ARMs. Like, hey, if you can get people to do the ARM, not only can you give them better cash flow now, but you get that as your refi client later. They're literally putting you into a position to have to work with them. You have to come back to them. Why go back to them if you don't have to? It keeps the banking industry from losing money. So if you want to be able to calculate this kind of thing for yourself, and I know a lot of people do, what I did is I created an app for them to be able to take the same information that I just showed you, the same tool, but it simplifies it a little bit more. And now they have the ability to get this QR code. I'm also going to put it in the chat where they can just download this doc. Is the sharing thing kicking up yet? Because it takes a little bit for the share to work. So here's the calculator. Just got to run the QR code here. You might have to pause if it's not popping up. I also have the download. You can just click on that. And what it does is it gives you the ability to go in. When you launch this, you have to put in your name, phone number, email address. Don't jerk me off with a BS name and phone number and email. This is how I get you more information when I hot rod this app out a little bit more. So here's what you're going to do. You're going to download the app. Here's what it's going to look like. It's going to be called, you're going to see this icon. It's called the QJO Investments tool, which stands for the Quit Jerking Off Investment Tool. The reason I call it that, because the people who are chasing interest rates are spending their time jerking off. They're not getting anything done. Well, you can calculate and figure out what's going to help you accomplish something. So what we're going to do here is you're going to go to the mortgage amortization calculator. You're going to click on that. And we're going to not click a little bit too much. So you click on the mortgage amortization calculator. You're going to type in something. In this situation, I just rounded up that last estimate I gave you to $150,000 purchase price, putting 20% down with an annual rate. I put in 7 just to see what it does. You can put in whatever rate you get when you call me to get the loan. I have the ability to put an additional payment. You don't need to do that right now, but if people want to put in additional payment to see how it affects, you can see by adding $100 a month when it will pay off. But then you can also see the inflation adjusted payment, comparatively speaking, and that you actually pay more. The faster you pay off, the more you pay because you're paying it back while the dollar's worth more. So here you'll calculate that. You'll see the current payments, right? And then you'll scroll down and you'll see that you've made one payment and the current loan balance. You go up to the upper right-hand corner. You will see a calendar icon. You click on that. Then you can scroll to the left. Yeah, swipe left, and you can check. You can change it year over year and see the effect of inflation every year for 30 years. So you scroll all in this situation. We scroll all the way 30 years. Select and close. Now look at. Now we can see over 30 years you paid $259,005.83 on that loan, but 8% inflation brought you down to $98,050.61 in actual dollar value paid out. Here's another little interesting thing to look at. In 30 years, $719.46, which is the payment, will buy you what you could have bought for $65 today. Isn't that crazy? That's just 8% inflation. And how do we know this? Well, when I was a kid, my mom could give me $1 bill. I could get on my skateboard, go down to the corner store, pick up a gallon of milk, a candy bar, and bring her back change. Can that be done today?
No.
No, hell no, it can't be done. You can't buy the candy.
Yeah.
Much less the dollar, much less the milk. So for those who didn't get your phone out, they thought, damn it, man, I should have got my phone out. Well, here you are. Here's the QR code again. Sometimes I think, yeah, everybody's got an app. And then they say, oh, wait a minute, I can calculate this crap. I can really see this for myself. So now here's you another shot at it.
Yeah, we're also have a link in the show notes. Aaron, I want you to restate a comment you made that I thought was very interesting. And that, I mean, a lot of people think, well, man, I just want to pay a little bit extra per month towards my mortgage because I'm going to pay less interest. Would you mind? I want to make sure we're clear. I really liked your response to that.
So when you're paying, and this actually is the same with like a 15-year loan. Now, some people say, oh, I'll just get the 15-year loan. I'll pay it off faster. Well, number one, the more you pay while the dollar's worth more, the more you're actually paying. Because if I paid it off in a 15-year, interestingly, I don't have this particular thing in here showing that. But when I run the numbers on a 15-year loan, I'm actually paying about $2,200 more in actual dollar value, $2,200 to $4,000, depending upon the loan size, because I've been giving them more money while it's worth more. It's really worth a lot less in years 16 to 30 because you've got that compound decline in the value of the dollar, right? And it stretches further. Well, they're still saying, well, I'm still paying that amount of dollars. Well, yeah, but as we can see, that amount of dollars don't mean anything later in life, just like with my milk example. So the longer you take to pay, the less you actually pay. Give them only what they want. And here, let me show you. There's some people say, well, why would a lender do a 30-year fix? That doesn't make any sense. If they're not making any money, why would they do a 30-year loan on this? Because it just seems like that they're going to lose money, right?
Right. Yeah.
If they allow you to keep running this out. So let me share another thing that you would find very interesting. So here this was an amortization table. Mm-hmm. And have you ever looked at your amortization table on a 30-year fixed?
Yeah.
Okay, so this shows you the first 4 years. Do you know how often people are refinancing their homes?
70% the first 7 years, I think, or something crazy.
Yeah, it's like first 4 or 5 years, a significant number of them. And that's by design. So if you look at this scenario, we had a guy with a $120,000 loan in this scenario. Mm-hmm. He paid 4 years of payments. 4 years of payments, when you take $719.46 per month and add it for times 48, you're going to get $34,524. That's what he paid in payments, $34,524. But he started with a $120,000 loan amount. After 4 years, his balance is $113,537. So he only paid it down by $6,400. Paid $34,000, but the balance only went down by $6,400. And then he got convinced to refinance. So let me show you my math just to make sure you guys are seeing it right. There's a $120,000 initial balance. There's the $34,000 in total payments, $6,400 in principal pay down. Here's the math itself. I put that screen in here too, just to make sure people can see that I ran the math. I'm not jerking anyone off, right? Here's his refinance, because his payoff was a little bit higher, right? Even though his balance is there, he still had a payment involved. There's a few things. Here's the payoff, $114,642 was the payoff. He took his estimated, his prepaid items, which is taxes, insurance, all that stuff to start the new impound account. Closing costs, only about $2,700. Where do they put those? They add them to the loan, right? Nobody wants to come with that out of pocket. Yeah. What's the new loan amount? What is that down there?
Almost what he started with 4 years ago.
It's basically $166 away, $166.04 away from where he started. Think about that. 4 years of payments, $36,000 left his pocket. He did a refinance, and he's done 4 years later. He's within $166.04 of where he started. Now, think about this. If the banks know psychologically how to get you to do this every 4 to 5 years, where are you going to be at in 20 years?
Same spot.
Within $166.04, right? But what about the guy down the street who kept that higher interest rate, kept making his payments? What does he have? He's got 2/3 of it paid off. And he paid less than what he borrowed because he paid it back with diminishing instrument like US dollar.
Mm.
That's why interest rates have been made to be the most important thing in a finance transaction. Find the best interest rate, call around and hunt the lenders and all that kind of crap. Because if they make sure that that's the most important thing to you, they keep you in financial servitude. I'm here to blow the whistle on their asses because this is my industry being predators. And I have told everybody, humans are the apex predator except when it comes to other humans. And I'm trying to stop that. And so some of the hardest times in my business is when the rates go down and everybody's calling wanting to refinance. We spend endless hours talking people out of those rate and term refinances. If it's pulling cash to go and expand your holdings, yes. If it's just refinancing because the rates are better, we talk them out of it all we can because it's wasting their money. And I would make a hell of a lot more money if I just went with the industry norms. Yeah. But I still have to put my head on the pillow at night and know that I'm not doing this just for the money. I'm doing this for the people that I work with.
That's why we like having you on, Aaron. He's one of the only guys in the mortgage space who's not all about refi. But another thing you're also a big proponent about, Aaron, is the infinite banking concept.
I freaking love it. Right now it's one of the hardest things for investors to do is find that house, right? Find the right property. And what I tell everybody is just finding something that you can keep reasonably rented for the entire time you own it and you can raise rents on. That's your job, right? To get the right people to work with and then find the right asset or the right business, if you will. You're buying a business. But it's harder to find that. So while you've got time, you should be building up your foundation with the infinite banking concept. You should start getting that life insurance knocked out. Get that out of the way. Get that thing set aside so now you have that. When I did that, and I think I've shared the story on here before, took $90,000, bought the policy on me, was able to pull 80,000+ out of it within about a month and a half, bought 3 properties, took the cash flows from those properties, started paying down the loan of 80,000+ plus 10% of my income. Within 15 months, I was able to get 20,000+ available to buy another property. Cash flows went up, income's going up, paying it down faster and faster and faster. That's 2016, guys. It's 2022. I have over $1.1 million on deploy that I've used my infinite banking for.
Awesome. Well done, Aaron.
Started with 90 grand. I got $1.1 million on deploy because we created an engine and we used it.
Love it.
Aaron, that was awesome, right? You were talking about kind of the approach that somebody should take to this, and almost everything you've shared is almost counterintuitive to kind of the common advice that's given out there.
Well, the reason the common advice is given is because look at the benefit to the person given it.
Yeah.
When I discovered that it's not about me and my income, is about the other individual and theirs, my income blew through the roof because you earn their trust. And if you don't have trust, you ain't got shit in this world. I look at myself and yourself as kind of like, look at the gold rush of the 1800s. And we may have talked about it before. Who made the most money during the gold rush?
The guy selling the picks.
Guy selling shovels.
Guy selling picks and shovels, right? So we are pick and shovel salesmen. The difference between us and the other pick and shovel salesmen, we just don't talk you into a pick and shovel and shove you out the door. We want to look at the map. Where are you planning on digging? What are you planning on doing? What's the thing? Saying, maybe you want to look here. We understand the terrain a little bit better than the average pick and shovel salesman to ensure that the person who drops that pick or shovel into the ground finds gold. Because if they don't find gold, then what they have is very, very expensive gardening tools. And nobody gets rich gardening. So if we can help them become very successful digging with those items, then eventually they're going to need trucks, heavy equipment, more people, and God willing, a train to haul that gold. And if they do, who do they come to get it from? Us. So we became ridiculously wealthy supplying them with what they need while they're ridiculously wealthy finding gold. everybody wins. But what happens is everybody treats business like it's a zero-sum game. It's like people go into war. The only people who win in war is the one that can outlast the others in devastation. We shouldn't be trying to kill each other in the process. If we're building each other up, we will all make something out of it. And what ends up happening, we make lots of it. Because the more everybody produces, the more everybody gets, the more everybody receives. It's exponential. Where it starts to get limited is when people start taking from each other. And my industry is great at taking from each other. That's why the average loan originator does 1 to 2 transactions per month, because they're taking from somebody. I did 1,378 last year because we're giving to people. We're creating, trying to create wealth for people that didn't think it was possible before because they didn't understand.
Right. Awesome, Aaron.
Aaron, thanks, man. No, I appreciate you. Right? This is I think the second time that I've seen you kind of go through that calculator, but every time, right, it just sinks in and you understand it a little bit more. And I think that's why people are coming to you. Right, is people want to know what to do, but they also want to know the reasons behind it. And so not only are you telling them, hey, we should do this, you also have the receipts, right? You've got the calculator, you've got the website, you've got all the resources that people need to go in there and understand the information that you're giving them. So, man, I appreciate you.
And you know what? One other thing that I think is unique about Aaron, not only are you selling shovels, you're actually digging for your own gold, right?
Oh,
you are a real estate investor. You are not just teaching people this, you are actually doing it. You are doing it yourself.
Yeah, I invest in real estate for long-term holds. I invest for flips. I have equity positions in companies. I do short-term loans. I mean, all kinds of stuff. I'm just when the deal's there, the deal's there. And having a whole life policy gives me the financial capability to do the deals. The problem is right now I have it all on deploy and there's deals hitting me like crazy. That's the other thing you'll find out is when you start finding these things, it comes to a point where they start finding you. And now all of a sudden it's like, I wished I had more to do more deals because I have more opportunity. So then you got to be more discerning about what deals you do consistently. And the one thing that we have been able to find is the one that continues to pay and pay and pay and pay is just the long-term holds on real estate. How many people have flipped in the last 5 years thinking, damn, I should have held those things?
Yeah.
Yeah.
Awesome, Aaron. Give us your website one more time where somebody can contact you, and then we'll be sure that we include the link for the QR code to get them the app as well.
Just aaronchapman.com works. If it doesn't work for you because you're using some sort of browser that's not liking it, go to Aaron B. Chapman, as in Bravo, B as in, it's not my middle name. It's not Aaron Bravo. So AaronBChapman.com. If you're still having a hard time, just Google Aaron Chapman. Look for the redneck with the braided beard. You'll find me. I'm right there on the first page. The other ones you'll find out is an author, a pastor, and a soccer player. And the closest I am to any of those is I do have books and I am an author, but I do none of the other stuff. Of course, I do preach. I preach alone stuff.
Well, Aaron Bravo, that's going to be, I was going to call you that from now on. Thanks again for educating our audience and Cameron on interest rates and inflation. You're always a wealth of knowledge, and we thank you.
Thank you. I appreciate you guys letting me come back on for another round.
Absolutely. Thanks, Aaron.
Now, go make it a fantastic day.
Take care.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.